And welcome back to the Financially Simple Experience. It is January of 2022. It's almost been 2 years now since COVID was first introduced on the global stage. We had 2020 and then last year, 2021. Just when we thought 2020 couldn't get any worse, many companies had a dismal 2021. Let me ask you a key question that I want to hone in on today, and that is this. How did your business perform last year? How did your business perform in the year 2021? So, Justin, we had all-time sales. Great. Justin, we had higher margins. Great. And Justin, we launched new products, new services, new segments. We hired more people. We laid off more people. We dealt with some hardship. You know, business is one of these things that it's a living entity. It's a living, breathing thing. It's almost like we created Frankenstein sometimes that takes on a life of its own. But today, I want to give us some meat on how we can truly judge how our business performed. And there are 5 key ratios that will tell us the story of our business. So first, let's answer the question, what is a key ratio? Well, according to Investopedia, a key ratio comes from data on like the company's financial statements, the balance sheet, the income statement, maybe the statement of cash flows, and then it compares the information on those statements to other items. These numbers then calculate out to provide us a ratio that represents certain aspects of the company's financial picture, such as liquidity or profitability or debt usage or earning strengths. So there's a lot of different things we can gather from this ratios that we're going to be looking at. Likewise, key ratios focus on particular aspects in the company. For example, EBIT or margin, meaning often it's necessary to consult several different ratios to get a very clear picture of what's happening. We've all seen a car wreck, 2 cars collide, more than likely by accident. And a police person comes on the scene and they start taking witnesses' statements. Of course, they're going to talk to the drivers of the vehicles, but then if available, they're going to talk to pedestrians around or other drivers who perhaps saw the event. And by looking at the event through the eyes of multiple people witnessing the event, they can see a very, very clear picture of what transpired. I'm reminded of a picture of an elephant, and one person who's blind is holding the ear. Another person who's blind is holding the trunk. Another person who is blind is holding the tail. Another person is holding the leg. And each person holding what they cannot see perceives a very different animal than what the elephant's full picture portrayed. So that's what key ratios do. It allows us as business owners to get a clear picture from multiple different angles to how our business is operating. So first and foremost, one of the most important ratios that you can calculate, and I challenge you to calculate this monthly, that is the gross profit margin percentage. Let me say it again. That's the gross profit margin percentage. So how do you calculate gross profit margin? Well, you're going to take your revenue, subtract your cost of goods, which gives us your gross profit. Then we're going to divide that number by our revenue, multiply it by 100. So on our blog, Financially Simple, we're going to have a sample income statement. And on our sample income statement, it shows that revenue is $102,000. And the cost of goods were roughly about $40,000, which leaves us a gross profit of almost $63,000. So we're going to take $63,000, divide it by $102,000, which gives us roughly a 62% profit margin. That's how you calculate it. But what does this tell us? Well, it indicates how much each dollar of revenue is retained as gross profit. You see, a lot of our businesses that we consult with, they have sales or revenue that could be millions and millions of dollars, yet they have high cost of goods. Maybe they're an auto repair company or a contracting company. We have a client who puts in water tiles for a city, and they'll have semi-truckloads of piping, concrete sometimes, polypropylene pipes sometimes that come in on the job site. Well, the gross margin, if someone says, hey, I'm producing $3 million in sales, Well, that's great, but most of that is buying the materials to actually be used on the job site. So it indicates for us, gross margin percentage indicates for us each dollar of revenue that is retained that we can spend through our expenses of the company. Generally speaking, the higher the gross margin percentage, the better. You say, well, Justin, we don't have very many cost of goods. Well, then your gross margin percentage is going to be extremely high. It could be in the 90 percentile. There are some businesses like ours that has very little gross margin, so we don't even have to calculate this. But if you're in the industry that buys supplies, goods and services that you're going to install or prepare for your customers, then gross margin percentage is one that you really want to track. Remember, the higher the number, the better. So how can we improve it? Well, you can improve it by lowering your cost of goods. You can use it by lowering your cost of goods. How do you lower your cost of goods? Well, you can do it through negotiating. You can do it through bulk pricing, bulk purchasing. Another way you can do it is by increasing pricing. You can raise your fees. Look, we're going through high inflationary times at this point in our cyclical cycle, the economic cycle. So now may be the time where you want to go in and increase your fees. So by increasing your fees, you increase your gross margin profit percentage, or by decreasing your cost of goods, you now increase your gross margin profit percentage. So that's one right off the bat, that if you're in business, you need to know how to calculate that. It tells you so much about how you can affect the profitability and value of your company. The second key financial ratio that I want you to understand is the net operating margin percentage. Net operating margin percentage. The net operating margin percentage is calculated by taking EBIT and dividing it by sales. Okay, so we know what sales are. That is the number of revenue. Some may say total income on your balance sheet. On your financial statement, it may say total revenue. It may say sales. Like some of our companies, we actually allocate it by divisions, revenue per division. But ultimately, that's the sales portion. But EBIT, you've heard me often talk about EBITDA, but EBIT is earnings before interest and taxes. Earnings before interest and taxes. So it's a very simple calculation that you can do by looking at your income statement. But if you take your EBIT and divide it by sales, it's going to give you the answer to your net operating margin percentage. Okay, what does this ratio tell us about our business and how it's being managed? Well, businesses with a high net operating margin percentage are typically stronger. They're stronger than those with a lower percentage. Again, the higher the ratio, the better. So if you happen to calculate yours and you find out, man, it's very low, what can you do to improve it? Well, it can be improved by increasing revenue. Yet again, you can raise your service fees. You can raise your revenues. It can be done by increasing sales. So you can not only increase the price, but you can go and get more sales. So by increasing your marketing, increasing your sales department, and earning more business, overall, not only increasing the price of the services, but now getting more services, you can at that point help to increase the margin percentage ratio that we're looking at. Similarly, by decreasing the cost in your company, cost of goods, it's going to increase the percentage, your net operating marketing percentage. So two common things here. If you see low ratios on your net operating market percentage and now on your gross margin percentage, then you can increase those numbers by charging more, getting more customers, or decreasing your cost of goods. A third scenario that you want to look at, or a third ratio you want to look at, is your debt to equity ratio. Debt to equity ratio. Now, if you've listened to me for any length of time, you know that I am totally debt averse. I do not like debt. But in business, there is a time and place for debt. So if you're going to calculate your debt to equity ratio, you need to know what are your total liabilities divided by your total equity. And both of these can be found on your balance sheet. Why does this matter? The lower the debt to equity ratio means that there's a more conservative financial structure in place for the company. You see, when you have debt, and I'm not saying debt is bad. I won't go that far. Debt has its place. But when you have high debt, you're now putting your company away from the ultra conservative financial structure that it could have. The more conservative you are running your books, the less risk you have. The less risk you have, the more the lower your company's specific risk, which means the higher the value of your company. So run your debt to equity ratio. How are you standing? Whatever that ratio is, you may make it a goal this year to actually reduce that, okay? To bring that number down. The lower it gets, the better it is. The fourth financial ratio that I want you to look at from your financial statements that'll help you determine how strong your company is and where you can make improvements this year in 2022 is what's called the quick and current ratios. See, these ratios are going to tell you if your business has enough assets to cover its liabilities for the current year. And if they don't show you enough, they don't show you enough to pay your liabilities, it could be a sign of impending trouble. So what we're looking for is, do you have enough float to cover your liabilities? So the quick ratio is determined by this: your liquid assets, which is your cash, accounts receivable. Some people would classify that as a liquid asset, but ultimately your cash divided by your current liabilities. So if I have $500,000 of cash in the bank and I have $200,000 of current liabilities, then my quick ratio looks good. I could take my cash and pay my liabilities off. Let's reverse it. I saw one here recently, a financial statement that had $1 million worth of current liabilities due with only about $800,000 of liquid cash and ARs to cover that ratio, to cover that liability. That's a very poor liquid ratio. And you're like, Justin, I don't need a calculation to figure that out. Actually, what it does is it's going to help us, if we start tracking this, it's going to help us increase the value of our company so we can prove how the float, the money's moving in, money's moving out of the business is long term. So that's the quick ratio. What about the current ratio? The current ratio reflects all assets, including inventory and equipment. Okay, so we're going to take all of our current assets and divide it by liabilities. So if we add up all the equipment, all the inventory, all the cash in the bank, all the properties we own, whatever it may be, we take that and we divide it by liabilities. What does that ratio give us? Do we have enough assets to cover 100% of our liabilities? If we don't, then our current ratio is going to be waning, and it's going to show us once again that our business is not operating as conservatively as we might desire it to be. So the quick and current ratios, you say, Justin, we're debt adverse. Great. Run the ratios, record these, because when the time comes for a buyer to look into the financials of your company, they're going to be running these. And if you can show them what your ratios have been over a period of time, it'll help you in your business actually potentially drive more value for your company. And finally, one that I deeply, deeply love, but yet one that I've yet to see many business owners calculate. This one ratio will keep you sane. I'm telling you, I know, guys. I know what it's like to run a business. I know the things we juggle. I sit down with hundreds of business owners per year. I speak to thousands, physically look in their eye, business owners per year. I know the weight we carry. I had a conversation this last week, before I tell you the ratio, with a business owner and his beautiful bride. The bride is not that involved in the business, a little bit of clerical duties, but not actively in the business as the husband is in this case. And we were going over the financial data. And the bride made a statement. She said, I feel like our family always takes second place to the needs of the business. And most of us who've been in business for any length of time would recognize that sentiment. Most of us understand that sentiment. Most of us have felt that way many times. This ratio that I'm going to tell you lastly, and probably one of the most important to me, is what keeps us grounded. When the winds of business come and try to blow us off of our goals, our mission, our values, this keeps us grounded. What is the ratio? It's your return on equity. It's how is the business adding value, monetary value to your pocket? What is the business worth, and how much did it increase over time? You see, unlike a stock that's maybe traded on an exchange, or crypto that's maybe traded on an exchange, businesses have a hard time, business owners that is, we have a hard time seeing what our business is truly worth. We can't turn on the TV, can't turn on Bloomberg or look in the Wall Street Journal and see that XYZ stock today took a 5% increase or a 5% decrease. We can't see that. What we do see is the frustration, the heartache, the pain, the struggle. I'm reminded of the picture of a muscular gentleman pushing a stone up a triangle, saying, this is what it's like pushing a business and growing a business. But friends, from one business owner to another, the return on equity is one of the most important financial ratios that you should calculate every single month. So what is it? Take your net income divided by the average shareholder's equity. You can get these right on the balance sheet. I consider this one of the most important financial ratios. The return on equity allows you to compare the return of the company, the return the company is making on your investments. And you can compare your company's return or growth compared to alternative investments. I meet with business owners sometimes that are weary. We've all been there. Weary. Man, business just takes its toll. And whenever I run the return on equity, I show them, look, I know the struggle that you're having. I've been there. But your business just gained 46% as a return on equity this last 12 months. Could you have made that return to accomplish your goals by using the stock market? And almost every time they say no, because we know the stock market, as I often call it, is slow money. It does make money, and it's one of the best passive investments out there, but it's slow. It's not going to make us the 20, 30, 40, 100% returns like our business can in any given year. Typically, it's not going to do that. It's going to kind of plod along. It's going to have its up years and its down years, but it's going to plod along. We have the ability, as long as we stay focused, by calculating this return on equity ratio, that we can stay motivated. We can continue to, as I often say, to charge hell with a water pistol. But friends, return on equity, if you're not calculating it, you're missing one of the best shots in the arm. I remember as a child watching Popeye the Sailor Man, the old cartoons. My dad would love them. And Popeye would pop that spinach can up, and all of a sudden muscles would come up, and he would be able to deal with Bruno or whatever he was dealing with. This is your spinach, proverbial spinach for us business owners. Calculate your return on equity. I would challenge you to do it every month. So the question was, how did your business do in 2021? Why don't you run these 5 ratios, compare 2021 to 2020, maybe 2018, 2019, 2017, and then use these ratios to set some goals in your finance department for this year. Maybe you're going to put a new return on equity goal for your business this year. Friends, I hope these ratios help you. I know we utilize these in our company day in, day out with our business advisors, working with business owners nationally, helping them drive ultimate value in their company. These are powerful ratios. You say, Justin, man, I don't know anything what you just said. It all sounds interesting. Hey, look, if you need help, reach out to us. We can help you. We have a team of highly trained business advisors and financial advisors who can help you reach your goals. We can help you gain clarity in your goals. We can help you with business strategic planning. We can help you with all the 8 areas of business that I'll preach about on the podcast regularly. These are a few of our trade secrets, and we want to share them with you. Friends, take these ratios, let's crunch out some data, and let's make 2022 the best year yet. Y'all go out and make it a great day.